Hey guys, welcome to LJ's daily housing market update. Today is February 5th, 2024, and let's get started with our interest rates. Interest rates for your 30-year fixed conventional loans actually went back up around 12 basis points from Friday's reading, so they are hovering around 7.04%. Compared to your FHA, they are hovering around 6.27. That's your national averages for your top tier scenario. Okay, according to Freddie Mac, the last updated was on February 1st, and according to them, their 30-year fixed mortgages were hovering around 6.63 versus their 15-year fixed rate mortgages 5.94. So you guys can look at this 52-week range as well. So we are around 7% as of now as your national averages. Does that mean you can get that interest rate? Yes and no, depending on your situation. When we say top tier scenario, just know that there's many factors. One is your credit scores. The better credit scores or higher your credit scores, the lower the interest that you will get. Your home location, your down payment, your loan term, your loan type, your residency, and units, they all matter when it comes to your interest rates. Next is your buying power. Last week we were talking about how buying power was increasing when the interest rates go down. Also, it decreases when the interest rates go back up. So even if they go up a little bit, it affects your affordability and your buying power. So if someone were to get an $500,000 loan at 7.04%, their monthly payment is going to be $3,300, 3339. That's their principal and interest versus a person who's going to go get a loan at 7.79%, which is realistic. It did happen a few months back and everything. And for that person, they were qualifying for $464,000. So big difference when the interest rates do drop. So keep an eye on it in the coming months. Okay. Next, let's talk about two different households, two different affordability scenarios. Number one is your annual income of $85,000. Again, this could be one person or more than one person in the family members, in family households. Their down payment was $60,000. Their monthly debt was their minimum payments that they have to make was around $100. We're going to use today's national averages for the interest rate. Your property tax is $5,000, and we have their property insurance $1,500. So this family can qualify for $441,000, and their monthly payment is going to be $3,087. And this is their DTI based on 45%. So you as a buyer, you want to have this as low as possible. You don't want to devote all your paycheck going towards your mortgage. You have other expenses as well. Second family, second affordability scenario here. This household income was $140,000. Their down payment was around $80,000. Their monthly debt was on the higher end because they had a car payment, so it was $400. Everything else is the same as scenario one, and this family can purchase up to $724,000. So 724 for this family, and their monthly payment is going to be 4850. So 4,850. Again, their DTI is at 45%. If they really like the property and it was around $750,000, maybe the loan officer can take it up to 49% or 54% depending on the loan. How about some extra payments? If you do own a house and you have a 30-year mortgage, you can turn that 30-year mortgage into 25 years, into 20 years, really depending on how much extra payments that you make towards your principal. So this last family that I showed you the example for, if they start making payments $300 extra towards their principal, they can save 5.4 years. That's 5 years off their, instead of 30 years, their mortgage will be done in 25 years, and they will save $193,000 in their interest saved in their life of that loan. So if you can afford to make a large payment, one-time payment towards your principal, that's good. If you want to just do $100, $50, anything helps paying off your mortgage, and you want to pay your principal. So the best way to do this, if you have an automated payment set up, let that payment go through, and then maybe after a week later throw something extra towards your principal. Some headlines in the mortgage and real estate related: mortgage rates back up over 7% as stronger economic data is rolling in. So we are paying attention to Fed meetings all the time. We are paying attention to the data that's coming in, your inflation, unemployment. These are all the numbers that the Fed is actually looking at, and then they determine if they need to cut down the rates or they need to wait on it. Another one is a 3% mortgage sounds too good to be true. In many cases, it is. If anybody tells you anything below, in today's market rate, you have to question that, which I'm going to go over in a little bit with you. Okay. Your inflation data right now, the inflation is around 3.4%, and the home prices have gone up over the years. And don't expect them to, reduce or the market to crash because the inventory is so limited. And the interest rates, when they're dropping, there's more buyers for the same property that want to bid on. So there will be a bidding war when that happens. Right now, in today's market, if you can afford a property, you see a property, making a solid offer and try to get that deal under contract. And let's talk about a loan option today. We're going to talk about conventional loan. When you do qualify for FHA, we want you to look at conventional option too. The reason being is that with FHA, your mortgage insurance typically does not go away. So with conventional loan, it does go away. So once you are a first-time home buyer, you don't want to worry about refinancing or worrying about removing your mortgage insurance later on. You want to have an option where you start today. As soon as you hit 20% equity, your mortgage insurance should remove, and a conventional loan can do that. So the guidelines for a conventional loan: you need 620 credit scores, right? If you usually get it from three different companies when you do a tri merger, make sure that the middle one is the 620 or above. For your down payment, it is 5%. A lot of people think you need 20% for conventional. You do not. 5% will get the job done in majority of the cases. Your DTI, your debt to income ratio, can go up to 49%. Your closing cost, it can be between 3 and 5% for your conventional loan. And some key points, as we mentioned: your mortgage insurance does go away once you have 20% equity. Your down payment, you can put down 5% for one or two family, but you do need 20% if you're going with three or more units. It can be for your primary or for investment. You can literally rent that out from day one, or you can decide to live there from day one. With FHA loan, you have to live there for 1 year, not with this loan. Okay. Next, guys, there's few listings on the market that we want to go over. Number one is in Farmingdale. This one is listed for 550, 4 bedrooms, 2 baths, here in Farmingdale, New York. Second one is listed for 1,088,000. It's in Leviton, 5 bedrooms, 3 baths. And this is actually to be built. It's not ready yet. So if you want to customize it in your own way, you can. So you can reach out to us. Next one is listed in Woodmere, and this is 4 bedrooms, 2.5 bathrooms, listed for 1.499. So again, it's a nice, big, newly constructed property. Okay. And the last one here is in Oceanside, listed for 789, 4 bedrooms, 4 bathrooms, spacious, split level. So a lot of pros in this property as well. So let us know if you want to see this property. So overall prices, home prices in New York have been gone up. I don't know about other markets out there, but since COVID hit, we have seen the prices dramatically, gone up and up. So not even looking at 2 years or 3 years back. How about looking at 60 years back? That should be enough data for you to look at. Even over 60 years, there has been prices appreciated overall. So if you're debating with yourself that, or with your spouse that, hey, should we buy, should we rent? Just know that overall, the home prices usually appreciate in New York. You guys can look at here, Queens versus Nassau, similar specs. Okay. And every day in these videos, we go through one person who's really involved in a real estate transaction and that can really help you out. And today we want to talk about your attorney. This person is coming in the game once your offer is accepted. Prior to that, you're working with your real estate agent, looking for properties. As soon as you found the property, you put in an offer, your offer is accepted. You want to hire an attorney. Tell them, hey, my offer is accepted, and I am expecting the contract to come in any day now. And he or she, your attorney, will receive the contract from the seller side. Now your attorney's job is to make sure that everything is in good order, meaning everything that should be in the contract to protect you should be there, meaning your bank appraisal contingency, your home appraisal contingency, your home inspection contingency. Anyway, who's going to be paying your transfer tax? The seller should be paying that. If for some reason in the contract it says the buyer's paying, that should be a red flag. So things like that, your attorney is going to help you. You should never hire an attorney that's going to be recommended from the seller side, just because I just don't want to have anything to do with the seller side when it comes to my attorney. I'm the buyer. I want to protect myself. Let me find my own attorney. Even if your real estate agent tells you, hey, you can use this attorney, if you're already working with someone before, work with that same attorney. If you don't have anyone, then your next best person to reach out is your real estate agent, and they can give you a couple of people that they recommend. But always check with the attorney, because they play a huge role. And I always say this: one line in the contract can cost you thousands of dollars. So choose wisely. Okay. Next, guys, if you're trying to save up and buy a house in 2024, couple of things. One, your income matters, right? Sometimes you want to add a co-signer, so their income matters, but their credit scores matters as much as yours. Sometimes we see, hey, I want to add a family member to the mortgage. Their income is great, but their credit score is not. You want to make sure we need both. We need their income and their credit scores. Your savings, that's what you're going to put in for your down payment and what you're going to use for closing cost. And your debt, you want to try to reduce your debt much as possible so you can qualify for more. When it comes to your credit scores for you and your cosigner, make sure that you guys have at least 580 credit scores if you both want to qualify for FHA. If it's going to be a conventional loan, both of you guys better be up to 620 or more. Okay. The higher your credit scores, the better for you. Okay, you will get better terms when it comes to better credit scores. And if we mentioned earlier, if someone is telling you, any of the loan officers out there saying, hey, I can give you 5% interest rate today, you should ask them how. How is that possible when today's national averages are around 7%? Are you asking me to buy it down? If they're going to buy it down, ask them two questions: what will it cost me for this buy down, and what will my monthly savings will be? So you can take your $82 in this example here and divide it, that $4,000 that's going to cost you, divided by $82 that's going to save, and it's going to take you 4 years to get that money back. And then you decide if you want to buy down or not. Okay, guys, we have 16 loan officer here at LJ Mortgage Team. We have 70 real estate agents, and we always be trying to be transparent with you, teach you guys, and guide you guys to be a home ownership. We know being a homeowner is very difficult. It comes with a lot of responsibilities, but we want to be that guide for you guys. If you're a real estate agent watching this, guys, check out LG Realty Team. We offer no, office fees, no desk fees. We offer all the tools that you need to close a deal. So reach out to me and we can help you out. That will do it from my end. Thank you so much for joining. I'll see you guys tomorrow.